lot of apprehensions on the GST impact, at least in the short term. There are enough and more brokerage notes which have come out which are making a case that auto companies, FMCG companies, pharma companies, they will struggle, and there will be an earnings drop off, if not 2 quarters, at least 1 quarter.
We don't know exactly, to be very frank. It is fair to say that there might be some short-term disruptions that might happen, but my interaction with some of the larger companies is that they saw this coming. It's not unlike demonetization, which arrived unannounced. In that sense, it was not expected by anybody. GST is something that we've been talking about for a long period of time. Now, there is a section of a trade which probably is confused or not ready. But I think one lesson from demonetization that we can take away is that India is an extremely adaptable country. I mean, people adapt to change. We are also fairly tolerant. So, I think, destocking and restocking, I mean, all this is something that the markets typically tend to look at the future. I think GST is now almost a present, it's not the future. And I think that unless that gets reflected into some form of earnings, which we will only come to know when the quarterly results come, I don't think the markets are going to be too bothered about what's going to happen on GST.
But in the near term, a market which in a sense is running on liquidity and hope, GST implementation will come at a cost. It will have impact on FMCG companies, pharma companies, auto companies, and it may be in quarterly aberration, but it will push back your earnings recovery by 3 months, 6 months.
Possibly. I mean, selectively that could happen. But my sense is that, again, I know we've been kind of talking about an earnings recovery for a long time now. But I think that the market is sensing an earnings recovery sometime in the second half of this year. We may talk about liquidity. Yes, liquidity is an important factor, but liquidity is always going to be important because without money you can't buy stocks, right? I mean, and given the way interest rates are in the economy, given the way inflation is, I think that I think we're just seeing the beginning of money flowing into equity markets from domestic savings. So I think, the market's just taking a pause after a big rise. I think GST is being used as an alibi for consolidation. And I think finally the markets will discount the future. My sense is, actually if you look at a model, you should plot this. I mean, it takes about 2-3 years after a crisis to set things right. Things started to go downhill in India in 2011, culminated into a crisis in 2013. It has taken us 2.5-3 years to get out of that from a macro standpoint. And it has never happened that, in fact, in the initial phase, when you try to correct the macro, you take a hit on broad corporate earnings, and that's what's happened in India. Last 24-36 months, we've probably seen Nifty earnings flattish to 2% compounding, right? I think somewhere now that is in the base now. And I think we should be seeing, with a good monsoon, with commodity prices down, oil prices down, inflation down, there could be a recovery around the corner in earnings. Now, whether it is delayed by a quarter or two because of GST, we'll figure that out. But my sense is that even if you look and if you plot the quarterly earnings between 91 and 94, it's quite interesting. You will see that 91 we had a crisis, and then Manmohan Singh and Narasimha Rao were there, and they took various steps to make things around. And if you plot the earnings growth during that time, it was almost flattish to negative. And then in September 94 is when the quarterly earnings spiked. But the market started to rally from September 93, a full 1 year ahead of earnings growing, right? So I think we may be seeing something very similar. 2013 onwards, we've been solving the macro crisis. It's taken us 2.5-3 years. Earnings have been flat. And now markets are rising and people are complaining that probably valuations look expensive, but markets typically tend to discount the future.
So the market is pricing in the spurt in earnings that will come in FY19.
Today, yeah, absolutely.
FY19 because largely the
Or
full
maybe
benefit
second
of
half.
GST comes in then, right?
Exactly. I mean, it could be the last quarter of this year, it could be the second half of this year, and then well into next year, right?
The problem is that markets have already run up in anticipation of strong earnings.
Yeah.
So let's work with the assumption that earnings recovery happens in second half of this year or first half of FY19. So when earnings recovery would happen, then everyone would say, look, stock prices have already run up. We knew this was about to happen.
But that always happens in the sense that because the market anticipates a recovery, when the recovery actually happens, the markets might go into a correction and consolidation mode. Until people are not... See, we have to understand that at turning points, earnings is always a lagging indicator.
Yeah.
The P goes up first
Yeah.
and the earnings follow later. Similarly, on the way down, if in 2008, in mid 2008, if you asked Indian corporates, they would say, I don't know what's the problem. The problem is in the US. My earnings are doing fine. But the market was sensing a problem and the P collapsed first and the earnings collapsed later on. So I think we are seeing the reverse of that cycle, happening now. Now, I don't want to kind of belay, I'm sure that there are certain areas or certain pockets in the market which are expensive. There is no doubt about it. But I think when we talk about markets, we talk of aggregate earnings, right? And I think that probably aggregate earnings recovery could be round the corner, whether it is 2 quarters down the line or 3 quarters down the line, we'll figure that out. But my sense is that markets are sensing a recovery.
Are you fully invested in this market?
No, we still have some cash.
Why is that? If you're so confident of earnings recovery, then you should be fully invested.
No, I think we are deploying cash as we go along. We don't look at a broad market call and invest. We look at, as we find individual opportunities, we tend to keep investing in the markets. So,
Where are you finding those opportunities right now? Because, that's the, constant stress point, right? Because valuations even for the mid caps and small caps have gone ahead.
Yeah, I think, I think what we are seeing is that, if you look at, the way I would look at opportunities, if you put them into 4 buckets, right? Bucket 1 is where there is great visibility. Everybody knows that these companies are growing. And that's where the market has re-rated those companies. Possibly you can't expect any P re-rating there.
For example, a Bajaj Finance.
Yeah, these companies are now doing well. The market recognizes that. And you could still earn equivalent of earnings growth, but you can't expect any P or price to book multiple expansion there. Then there is the second bucket, where the balance sheet is good, but the P&L was not doing anything for the last few years, right? So either because of company specific issues or because there was headwinds in the industry, for whatever reason, but at least these were companies which didn't have a leveraged balance sheet. The balance sheet was fine, but there was no revenue momentum. I think that's where the opportunity is today. It could be across several sectors, right? The third is the most leveraged companies, where the P&L and balance sheet both were bad, and now we are seeing a deleveraging cycle. But there again, which ones will survive and which one will thrive, we don't know. Our sense is that it's better to play seen rather than play blind in that bucket, and it's also the most risky bucket, so to speak. And the fourth is where you look at new opportunities when new IPOs come, if there are interesting companies there. So I think essentially today the idea is, how do you create a portfolio between these 4 buckets, right? The first one is very simple. They are your compounders. They are well discovered stories. The second one is where you have to really do some hard work, right? And that's where you find opportunities. Like, for example, our sense is that, for example, once GST rolls out, right, I think you will see progressively, not immediately, but progressively, that SME balance sheets will be more credible, because now everybody has to pay taxes, right? If you're in business, you will pay taxes. And today, I think banks will be most happy to lend to an SME balance sheet which is more credible than what it was in the past, right? And today there were banks which were, or NBFCs which were specializing in lending to to SMEs, but it was always considered to be an area which was high risk, right, compared to lending to a consumer, for example, or whatever. And I think everybody gravitated towards retail lending because that was so easy, mortgages, so on and so forth. But today SME could be a big opportunity.
So how does one participate if you're bullish on SME business?
So you look at banks which have a large exposure to SME.
Okay.
Look at private banks which have exposure to SME. Look at NBFCs which
Regional
have exposure
banks,
to SME.
regional
Regional banks,
finances.
regional private banks.
Okay.
NBFCs which are focused on SME lending. I mean, that could be a big area of opportunity that could open up over the next few years.
Now, on a public forum recently, you've gone and made a presentation that you like Varun Beverages. It's in public domain now.
Yes.
So Varun Beverages falls in which bucket?
So Varun Beverages falls to some extent in the second bucket because I think that the capex phase is done, and we are now going to see the benefit of growth. They are also likely to see significant savings from logistics costs because it's a very freight intensive industry, and as they get contiguous regions to sell, the asset utilization will improve from here onwards, right? And I think the third thing that I mentioned there was that I think once this government is focusing on power 24/7 to be rolled out, and if power is available, then you can sell soft drinks and water and juices, right? Because if you had only 2 to 3 hours of power, you didn't have refrigeration. If you didn't have refrigeration, how could you sell, right? So I think there are multiple levers for growth there. There is relative underpenetration in that market. But again, this is my disclaimer that we do have an exposure to that company, and you guys should do your own research and
What do you own
decide.
from the bucket one? Which is the easy bucket, which is open bucket, right?
No, we own auto companies. We own Maruti, we own Bajaj Finance, we own HDFC Bank. We own the good quality companies.
That's how much of your portfolio?
That should be 35-40% of the portfolio.
Okay.
We're talking about ITC today. Where would you, how would you look at
We
it?
own that as well. I mean, but we bought that a couple of months ago.
I would reckon that would be, also bordering between case 1 and case 2, right?
But so that and the liquor companies, for example, what has happened is that in the last few years, they've faced a lot of headwinds in terms of incremental taxes. And now with GST coming in and there is a cap on cess, I think that a lot of the bad news is in the price. So both ITC also witnessed almost negative volume growth for a long period of time. And when you aggressively raise taxes and you have to raise prices, it impacts demand. But what happens after a point in time, the consumer gets used to a new price point.
True.
And once that happens, and all of that is in the price, so compared to other FMCG, for example, ITC underperformed for quite some time.
That's
right?
true.
So I think those are what I would call as companies in the second bucket, where something either specific to the company or because it was external to the company, there was a lot of headwinds. The same thing has happened in liquor. I mean, you had so many bans in several states. Then you had the Supreme Court edict coming about the 500 meters from the highway. So they've been taking it on the chin, but these companies have been doing good work internally. They've been cutting costs, they've been trying to crunch working capital and capital employed in the business. At some point in time, volume growth will happen, right? And that will be in the price. So typically when the crisis hits the most is when you get these kind of stocks at a very good price. So, my sense is that they are all in a bottom formation, and hopefully over the next few years these companies will do well.
Closing comments at least, closing questions from my side at least. The reason why Alchemy is given a return of 22% CAGR is because you've not...
26%.
26%, okay, it's 26 now. Okay, markets have gone up. I
You've
forgot.
outperformed the market.
No, that's not because of recent, but it's over 15 years. We just
I
finished.
stand corrected.
Yeah,
Okay,
15 years of
26%,
track
it's a
record.
fantastic return. It's because you've looked outside the index, right? You bought a Bata, Bajaj Finance, a lot of these stocks which have been multi-baggers for you. So if you have to make another bucket, which is bucket 5, bucket of multi-bagger,
Yeah.
A bucket of new ideas or which have potential to give an earning, CAGR return of 25 to 30% for next 3 to 5 years. What would you like to buy in that bucket? That could be a small bucket right now, right? But that bucket can really become
See,
big
to
bucket.
be fair, Nikunj, one of the things after also having managed money for 15 years is one has realized that people feel that there is no money to be made in nifty stocks. That's not true. That's a perception. I think even within nifty stocks, there are opportunities.
Yeah.
Like 3.5 years ago, you could buy Maruti at $1,300.
Yeah. I remember
And it has given return probably on a risk-adjusted basis better than probably some of the mid-cap stocks would have given, right? So I think we should not belittle the fact that even within the Nifty or the top 100 companies, there are companies that give you phenomenal returns. And that's one thing that we've realized, because early on when you start managing money, you think that you can only make stellar returns by buying something which is undiscovered. And that's
GST
true.
Bank.
No, that's
IndusInd
true.
Bank.
Exactly.
Yeah.
So I think you have to have a mix. Having said that, you talked about the fifth bucket or whatever. To be fair, initially you never know, but you do believe that there are some characteristics in certain businesses. I think some of the companies in retail offer that today. I think that's an industry that's consolidated. I think consumption is likely to grow. We've taken a few bets in there.
You bought Avenue Supermart?
Sorry?
Have you bought Avenue Supermart?
DMart.
Yeah. I mean, we got some in IPO in some of our foreign funds that we advise.
Possibly couldn't have missed that. There's no way.
But for example, we own VMart, other than DMart as well. So that's done phenomenally well. But again, my disclosure and disclaimer that whatever specific stocks I've talked about, we have interest in them, we have exposure in our client accounts and within Alchemy.
Just
so please
very
do your
quickly,
own
one
research.
last question, because
Yes.
most of your themes are consumption or consumption oriented. I see retail also as a consumption play at some level, right?
Yes.
I see the same with healthcare, hospitals, and with aviation. What about the dirty dozen that we've been talking about? Because those are the really cheap ones, and they really tend to confuse investors when they see these kind of price moves.
Which ones?
Prakash Associates and the likes, GMR and the likes. Because
GMR,
they're the theme right
GVK,
now.
Lanco.
We don't have exposure in the dirty
Would you
dozen.
shop there at all?
That's the dirty bucket, right?
Yeah, that's the
leveraged.
the leverage bucket. As I said there, and I think a few days ago RJ made that comment as well, and which was very appropriate, where he said that probably there will be 30, 40, 50, 100 companies which are there in that bucket, and a few of them will really...
The ones who will survive will become big.
It will become big, but we don't know. My own understanding is that they will go through multiple layers of re-rating, right?
Okay.
And we have to decide that, especially when we are managing external money, we have to be very careful about what we buy there. My own understanding is that it's better not to preempt, and it's better to play seen rather than play blind in that bucket. Because even after all the restructuring is over, it will give you enough chance and opportunity to make money.
That's the moot
right?
point there.
And it's not going to be as if that, they re-rate once and then that's the end of the story. Because there is a lot of slip between the lip and the cup in these kind of stories. Okay, something is getting sold, something is getting restructured, it happens, it doesn't happen, the stock goes up, the stock comes back down. I think it's better that you play seen, and especially, these kind of stocks, when you're not managing other people's money, it's fine. But when you're managing other people's money, you have a fiduciary responsibility. So you have to be careful.
It's a great point. Look at an example like Arcom. A year ago it appeared to us that Arcom will survive,
Exactly,
but they are in a position where they have to go through the bank and they have to restructure the entire debt structure. DLF has survived, but Unitech has not survived.
SpiceJet. Ashok Leyland is another story, but SpiceJet.
Exactly. I mean, you will always get one or two examples in some of these sectors which will be the multi-baggers in making. A classic example here is that after the dot-com crash, Amazon fell by 98%.
Yeah, that's true.
98%. And from where Amazon has reached, I don't think in 2001 or 2000 anybody predicted that Amazon would be on course to become one of the most valuable companies.
Yeah, but what if you didn't buy Amazon, you bought something else,
exactly.
right?
99% of the dot-com companies have not
Manage your
suffered.
risk.
Exactly.
Okay. Appreciate your time. And
Thank you so much.
Really,
Thank you
thank
so
you
much.
for